the current debt model here in America today. We have 1.7 trillion in student debt. We have 1.5 trillion in auto loans. We have 1.2 trillion in credit card debt, and we have 12 trillion in mortgage debt. Obviously, those of us that are loan officers, and all of us are, understand this blindingly well because we deal with the people all the time. So again, the question that I just asked was, if I can show you how to eliminate all your debt in 6 to 9 years without spending any more money or making any more money, would that help? Could it help you? Could it help your clients? Yeah, of course. So why deal with uncertainty when certainty is possible? This gentleman, I'd highly recommend this book. It's a great book. It's called Pirates of Manhattan. But the author says here, money must reside somewhere. When viewed in this light, of all the alternatives, permanent cash value life insurance is perhaps the safest and most economically efficient holding tank of cash savings within America today. Honestly, how many of you have ever thought about using an insurance company as your bank account? Anybody? Okay. That's what we're going to discuss today, by the way. Now, I found this just the other day, kind of interesting. Janet Yellen, the Fed chair, she said, I don't believe we'll see another financial crisis in our lifetime. And that was back in June of 2017. Anybody want to bet on that one? I got a lot of heads nodding yes, no right now on that one. Okay. So something has happened in our financial world that didn't happen in the past. Back when we had the run on the banks between 1929 and 1933, the Great Depression, and I apologize for this question that's so blatantly obvious, but what did you have to do to get your money out of the bank?
Physically go to the bank and request a withdrawal.
Physically go to the bank. Not a tough one, right? Okay. And what happened on March 9th of this year with the Silicon Valley Bank?
A bank run.
It was a bank run. And what was that bank run done on? The cell phone.
A photo.
Yeah, it was done on a cell phone. So here's what ended up happening. I don't know how many of you know what happened, but one of the venture capitalists that works with Silicon Valley Bank, they told some of their folks, hey, we're worried about Silicon Valley Bank, pull your money out. Well, how long did that kind of gossip take to spread on Twitter and WhatsApp in Silicon Valley? Customers withdrew $42 billion. That was 1/5 of SVB's total deposits in just a few hours. Big difference, huh? And we don't think about that because we've been taught to believe that banks are solvent. But the reality is we're living in a new world. And so what I'm talking about here is you comparing an insurance company to a bank. Now, again, in the other presentation I give, I go more in depth here. I only want to make 2 points, reiterate them. When we're talking about using an insurance company as the warehouse for your money, let me ask this simple question. When Nexa deposits your checks in that Wells Fargo or that Chase account of yours, who owns that money?
The bank.
Exactly. The bank has complete, utter control of that money. Most Americans don't understand that. If you're using a mutual company, not a stock-based, but a mutual-based insurance company, and you put money in there, who owns that money?
You do.
Yes, we do. Because, see, mutual insurance companies do not have stockholders, unlike a bank, right? And so here, we are the owners of our cash value and our policies. Therefore, we are also the owners of the insurance company. So the fiduciary responsibility of the executives at a mutual company that's a whole life insurance policy company have their responsibility to whom? I know I'm reiterating the same question, but who is their fiduciary responsibility to? We, the owners of the insurance policies, versus here, it's the stockholders. So anyhow, we also know the difference between the rates at a bank. They've been coming up because rates have gone up, but even so, insurance companies typically pay out 400 to 600% more money on a savings account than a bank would. So another point I want to is on the borrowing side of comparing banks to an insurance company. If you borrow money from a bank and you pay that loan back, when you get to the end of that 30 years, we do this with our clients every day, right? We put them into loans that they have to pay off in 30 years. When they get to the end of that 30 years, how much money do they have saved in their banking account? Zero? Okay. If you were to do the same project with a whole life insurance policy, your cash value has never gone away. It continues to grow at compounded interest throughout your life, and it's never taken out. So you borrow money, you end up with two pots of money. You borrow money from the insurance company's general fund, but your pot of money never goes away. It continues to grow. And that's how you get arbitrage, because you're able to use that twice. I'll go more in depth in that, but are there any questions? Because I know that's like a crazy concept to grasp. Yes, Sade.
Not really a question, but what you're going over right now, a lot of the gurus I watch in real estate, they do that. They borrow from the life insurance policy.
Absolutely.
And that's how they acquire real estate, and it continues to keep paying them on their money.
Right.
But I heard with large lump sums of money, like 100K or more, it's good to utilize like a life insurance policy. I don't know if what you're asked or what your take on it is as far as the dollar amount you're investing.
Yeah, he talks about it right here in this book, Sade, on page 400 and something. Tony Robbins in Money, Master the Game. And you're right. So that's why my other class is on building that wealth. Today's class is on getting out of debt. And so it's really a two-pronged approach, but let's start with the first step, which is getting us out of debt. And I'll show you how we do the debt action plan and then how to build wealth later and use it for investments. But by the way, that is the very issue that got Mike Cordes interested in this, is because I showed him a video that I've got on my website that I've done on how to 3x your investment as a real estate investor using private equity banking. But today's class will continue to focus on getting out of debt. But thank you. Very good point. Another question that I ask: how much of your financial security depends on people, companies, economic situations you can neither predict nor control? And we all know that's a good percentage of it. So I had to throw this in here. Remember back in high school, math story problems? That's what the library in hell is filled with. So here's your math story problem for the day, folks. Don't hang up on me. If your money's earning 4%, does it make sense to borrow at 6%?
No.
Okay. Mike says no. Any other answers?
No.
Another no?
No.
George says no. Well, what if I said yes? Let me show you how.
Okay.
Yep. Go
Yeah.
ahead, Sade.
Well, I'm just thinking if we're talking about in today's society, and I don't know at what point in the world, but usually you're going to borrow a lot higher than that. So if I was only actually getting charged 2% on the money that I'm borrowing, I probably would sign up for that, because anywhere else I go, if I'm not making money on my money, well, I'm actually going to just be losing a lot more.
Exactly.
So if you're only charging me 2%, I'll settle for that.
The difference, exactly. So very good. That's where we're headed. So a car costs $30,000. You have two options. At least this is what we've thought: pay cash or borrow the $30,000 at 6% for 5 years. So here's the mentality that we've been taught: you save your money until you get that $30,000, then you go buy a car and you trade your money for a car, and your money goes to zero, right? And then we save our money again and we go do it again. But every time we've purchased something, our money goes to zero. Then the other way of doing it is we go borrow that money, which is what we do for a living, right? And then people pay that off. And again, when they get done, they're back at zero. Well, what if you didn't have to utilize your money and lose that opportunity cost? And that's what we're going to talk about. But let's look at the first one. So pay the cash option. How much has your $30,000 grown over the next 5 years if you paid cash for that car?
Zero.
Zero. Good answer, Greg. Thank you. Zero. Now, let's say option 2, you borrow it. Again, you leave the cash in the bank. You're borrowing. Your bank is paying you 4%, and you're borrowing at 6%. So in year 1, that $30,000 has gained 4%, and it's grown to $31,200. You've borrowed, and you're paying down on that loan, and so now it's down to $24,695. Everybody's with me because we're all loan officers, right? Year 2, your savings account at 4% has grown to $32,448, and the payments you're making on that 6% loan have shrunk to $19,000. You guys get the idea. The next year it's 33 that it's grown to in the savings account, and what you're borrowing is down to 13. The year after that it's 35,000 in savings and 6,000 in what you owe. At the end of this 5-year process, your money has earned $6,499, and you've paid $4,799 in interest. That's a net gain of $1,700. Is that a better game that Charday just pointed out? Yes, exactly. And that's what most of us don't think about, is how to make that a reality. And that's what private equity banking can do. And this is what's called arbitrage. So again, we've got the saver mentality, save up your money and then go to zero, or the borrower mentality. Now, if we throw in the insurance company acting as our bank, we get another mentality. What ends up happening is we borrow enough money from the insurance company to buy that vehicle, and then we pay that off in 5 years, but we never went to zero because we never had to use our cash, because our cash was used as collateral and it kept growing at whatever that contractual rate is, usually somewhere between 4 and 6%. Does that make sense, how that continues to grow and how we never go to zero?
Absolutely.
Okay. And that is the new concept that we throw in here. So the IRS calls this a cash value accumulation contract. That's the actual term that's used if you look it up in the IRS code. Contract being the key word there. So again, how much of your financial security comes with guarantees? Okay, Charday shaking her head. No, right? Not much of our financial security comes with guarantees. So this is going to be a customized turnkey debt elimination system based on proprietary software and that comes with written guarantees. So why focus on debt first? For the average American home, for every $1,000 they earn, we spend 40% of that on taxes, or $400. We spend 23% of that, or $230, on lifestyle. We spend 34% of that, or $340, on debt service. And we stick away into savings or investments only 3%, or $30. If you go and talk to a financial advisor right now, and you can multiply this number by anything you want, right? For every $1,000 you make, let's say you make $10,000 a month, what is of these four does your typical financial advisor focus on?
They talk about the savings and the investing and such. And
Exactly.
before you even get there, you need to ask people, how are they even managing their money? You know, so that maybe they can't save, but maybe they possibly, in their mind, it's a placebo. You think you can't save, but you need to go back, focus on your foundation. How are you spending your money? So if they focused on debt service, I think you will have a lot of more people having more funds to invest and save.
Exactly.
So, I don't know.
And by the way, these numbers don't matter. You can be a doctor or a school teacher. This is how we spend our $1,000. So here's what we try to do. We focus on getting people completely out of debt and getting rid of that 340 instead of just adding to that 30. Okay? And here's why. Here's the return. On that $30, if I made a 10% return, which would be a pretty good return, I'd be making $3. If I get rid of only 1% of my debt of that 340, I've just eliminated $3.40. We all understand that because, again, this is what we do as loan officers, right? I mean, you could think about making 20% and you're still only going to get $6. And this is something that, and what you just said, Charday, is something that Warren Buffett said. He said a friend of his, he was being interviewed by CNBC Money, and he said that a friend of his had come into some money and she called him up and said, hey, where should I invest it? And his first question for her was, well, do you have any credit card debt? And she said, yeah. He said, how much is it at? And she said, 18%. He said, well, pay that off first, right? He goes, if I owed anybody 18%, I'd pay that off first. Because he said, I don't even know where to make 18% right now as a guaranteed rate, right? So this is the reason that we focus on it, right? By paying off the balance, she would save more money on interest than any return she could get by investing in money, whether in the stock market or real estate or anywhere else. This is what Warren Buffett told her. So he goes, I don't know where I can make 18%. So again, this is why we focus on people getting them completely out of debt first. Again, you get rid of 50% of your debt, you just put another $170 for every $1,000 you earn back in your pocket. But if the average family in America makes $87,000 and we can wipe out 34% of that, that basically comes out to about $30,000 without having to make any more money. Let me ask you a question. How much, or how would 30,000 in extra annual liquidity help the average American family? Or better yet, how would an extra 30,000 help the average loan client that's trying to get real estate? You understand why Mike asked me to do this now, right? I mean, think about it. How many of your clients, if they had that extra 30,000 in liquidity and zero debt, could buy a different piece of property? And I'm not saying that they spend more money. They could go buy a fourplex. They could buy whatever. But it kind of takes our job from being a transactional issue to a transformational issue. And that was why Mike asked me if I would show this concept to the loan officer. So if this is debt elimination, that's our job. Is it's not transactional, it's transformational. If you could help your clients get out of debt in 6 to 9 years, do you think they're going to remember you? Yeah,
Absolutely.
absolutely. So that's what we do. So here's how I actually do this. And I'm going to show you our software that we use. Again, I can name it anything I want. So, I just called this one John Smith Scenario because I don't have much of an imagination there. But here's their home mortgage. And I put in here the principal, etc. And then what their interest rate is, their monthly payment, it'll come up for me. And I can continue to put this in. So if you've got a real estate investor, I can put in as many properties as I've got. But let's just say this is the normal family. Now I jump, so that was the mortgage side. I'm not going to spend a whole lot of time showing you software, but the idea. Consumer debt. So I then put in their visas, all this stuff, that the information that you guys are already, or all of us are already grabbing as loan officers, right? So now I'm on consumer debt. It's a visa, it's revolving. Let's say they've got a $20,000 principal at a 19% interest rate. My software will tell me what their minimum payment is. What I'm going to ask the couple or the person is, what's their actual payment? Because if you ask people what they're actually paying on their credit cards, it's usually a little bit more than the minimum, right? Because they want to get that sucker paid off before 40 years or whatever it's amortized at. Okay, so I now have an overpayment of $83. This is how I'm going to find the money to help your clients get out of debt. Because again, what I say is 6 to 9 years without earning any money and without spending any more money than they're currently spending. So what I'm showing you is how I help people find that money that they can use to get out of debt. So right now I've got a monthly redirect of an extra $83. Then I go to the next card, their Amex. Again, don't need to walk through all that. But let's say that their minimum payment's $250 and they actually pay $450. Now I've found $283 to help them put toward getting out of debt completely with a private equity banking account. Discover. Now on this one, Discover throws in those cute little things where they say, oh, well, you don't have to pay any interest for 6 months. I've got the ability to go into my software and say, okay, this one's not going to be paid for an extra 6 months. It's going to be at 0, so act accordingly. Then a car loan, you get the ideas. I just keep going through all of their debts with them. So we've got that listed. Now, most of us get that information. We all have to get this information when we get loans. So this is something you've already done with your clients. And now I've got, and oh, by the way, on this one, what I said is although they had 483, that they were only putting in 400 actual toward this. So now I bump this to another 100 investments. I'm going to say that this couple is putting in, or this John guy is putting into savings, his savings account. He's got an account with $10,000 in it, and he's putting in $100 a month. And so there's that lump sum. So now I've got a lump sum that he might be able to use to throw in. And by the way, I just did this for a young man who's only 24 or 5. I don't know. I think I got a picture of it here in a second. But I just did one of these a couple weeks for a young man. And when he first looked at this, he was like, well, I can only put in like $150. And then when he saw what it could do for me, he was like, oh, okay, well, let's throw in 500 and wipe this thing out. So again, investments, his qualified plans, the 401k. And I'm not going to monkey with these with most of your clients, folks, because there's the penalties for taking it out. So what I did when I was at a job that was a normal job where I did have a 401k and my company was matching it, I put in the max that they would allow me to have, and then every single year, once I got my bonus, I just pull it out and shove it into one of these cash value insurance policies. So again, now I've got $700 available that they can redirect, and a lump sum of $10,000. That still hasn't changed. Now salary, John's salary, he's making $10,000 a month, and I'm not going to put anything here to redirect. So I'm not trying to squeeze more money out of what he's already doing. What we're going to do is end up wiping out his debt without having to do that. This is my policy, by the way. You can see my name up there. When I first got approached by this, the gentleman that approached me was the same. He was saying, well, let me help you get out of debt. And at the time, my wife and I had a car and a house. That was it. That was the only debt we had. And so it was going to take like $770 or something like that to get us out of debt in about 7 years. And so I looked at the math on this thing and I was like, hey, I don't want to do $700 a month. I want to put in $9,000 a month. I was talking to, was like, okay, slow down, cowboy. And so we ended up with me putting in $5,000. But I've been doing this now this is the 4th year. And at the end of this year, I'll have about $200,000 sitting there in my quote unquote savings account in just 4 years. And we're
Are you able to transfer any of your funds, like from a a retirement account into the whole life policy?
Usually, well, yes, you can do it, but without penalties is what I'm guessing you're asking. And no, usually you cannot.
Okay.
And that's why I don't usually tell people to do that. Although my daughter was visiting us for the 4th of July this weekend, and she said, Papi, what would you do? And I said, I'd pull my money out of my TSA account. She's in the Air Force. She's getting out. She's got 18 grand in it. And I said, yeah, I'd get out of that. But that's because she's my daughter, and I understand this stuff. But I usually would never tell somebody's client. What I would end up doing, George, is because I'm not a CPA and I don't know nor your client's situation from a CPA standpoint, I would ask that person to get with their CPA. And if their CPA thought it was a good move, then I might do that for them. But I usually don't advise in that arena because it's not my arena to advise in. Does that make sense?
Yes, it is.
Yeah. So my daughter, yes, this weekend I told her to. Me personally, I did that, but no, as a normal course of business, I don't suggest that to people. I ask them to sit down with their CPA. So I can give you another example. A guy about a year ago, he went and talked to his CPA, and they came up with a plan. Don't quote me on the number, but it was like $7,000 a year that he was going to pull out of his 401k that he could do year over. I don't remember how many years it was. And that's the plan that they came up with. And so I just incorporated that into what I built him. But it wasn't due to Eric's advising. That was due to he and his CPA discussing what this could do. Does that help that answer, George?
Yes, it does.
Okay. Thank you.
Thank you.
So again, the paycheck, I usually, in this one, I just put in $100. But like I said, when I saw mine, I jacked that sucker up because I understood what I was doing. At the time, I was making between $13,000 and $15,000 a month, just to give you guys an idea. So I was taking about I ended up taking about 30% of my income and throwing it into one of these accounts, just as a round number there. I had tried to put in 2/3, and the guy that I was working with told me not to. So again, insurance policies, I'll go over existing insurance policies with your clients. If they've got a term insurance policy, they'll probably end up being able to get rid of that and put a whole life death benefit in its place. That having said, again, I don't normally tell people to get rid of insurance that they already have because they got it when they were younger and healthier. And it's going to be cheaper when you were younger and healthier than it is today. So again, that's a case-by-case issue. So before asking me if I ask people to get rid of their insurance, I usually do not in that case either. Again, if they got a term policy, maybe. But again, it just depends on the circumstances. So there's another 200 that we'll throw in on this. So now I've got 1,000 here as my example and a lump sum of that. Here's that kid I was telling about, 27 years old. And when we first started this thing, he was like, well, I'll put 150 in. As it turned out, he ended up putting 520 in, and he threw in a lump sum of about $5,000. So you can see what this young man's going to have for himself moving forward from a cash value standpoint. But he was like, well, I want to buy a car. And I said, okay, well, it's going to take you to buy the car that he was looking at was about $30,000. It's going to take you about 5 years to get to that point. But now when he borrows that out, again, his 30,000 continues to grow at 5.2% or whatever it's at, and he can borrow at a different rate, probably if it's with the company that he's with at 5%. So he's making 20 basis points on that spread. So Charday, you answered correctly on the question I asked where it was 4 to 6. But how about in a place where he's actually making 5.2 on his cash, and when he borrows, he can borrow it at 5? Any of you loan officers here know of a lender inside of Nexa that'll give a signature loan and pay you 20 basis points to take the loan? Kind of a stupid question, huh? Doesn't exist, but it does exist here. So, there's his numbers. Okay, so then what I end up doing is I'll put together a report for your clients, and it'll look like this. Or I can do an avalanche where we go with the highest interest rate first. I have the ability to sit there with your clients and decide what they want to focus on first. Now here's a cool tool that I can then walk through all of your clients with. So this is the current plan that this fictitious John would be on, and this is using a debt action plan. And you'll see that at 10 years and 5 months, this fictitious John that I've created will be out of debt instead of 24 years. So let me walk you through what some of this looks like. So this is the comparison. So I'm at year 0, month 5. And if you look at it there, we've got more debt. I mean, more debt would have been paid off if they were continuing to pay the extra here than would be here. But what happens also is that we have a cash value now of $5,308. And so if I move over to year one, month 5, not year 0. Now this client has $18,000 in cash value in there, and they have a Visa. Well, if they had done it the other way, if they continued to pay the extra they were currently paying on their Visa, they'd be down to $14,500. But doing it this way, they're a little bit behind. But now watch what they do. They take this $18,000 that they've got in cash value, they borrow against it, they pay off this debt of $16,000. All right? And you might be thinking, well, they're just swapping it. Yes, they're paying off a structured loan, i.e. the credit card that they must pay on every single month, for a non-structured loan, a loan that they don't have to pay on. Let me ask a quick question there. Why do you think an insurance company structures their loans as non-structured? In other words, the payment is according to what I want to pay back and on my time schedule, and not like a typical bank that's every 30 days. Why is that? Why do you think an insurance company doesn't force you to make payments on a loan?
It's your money.
Exactly. One, it's your money. And two, what is that money still? Because this is, and I haven't talked about this term yet. You haven't heard me say one word about death benefits yet, but there's still a death benefit tied to all of these policies, isn't there? So I just showed you how much I had on my policy. What was it? Almost $200,000 in cash value. But did anybody see what the death benefit was? It was like 1.3 or something million. I don't remember. I'd have to go back. There's mine. Okay, so I'm in year 4. I've got about 1.17 million in death benefit. And Diane and I, when we moved here to Texas a year ago, we borrowed $60,000 to buy the house that I've got. And we used that as our down payment. And I've not paid any of that back yet. So I still have a $60,000 note out and have an earning one, but my cash value is earning about one. I'm in between these 2 years right now. So somewhere between 140 and 199,000 is what I've got in cash value. And I've got a note out at 60. If I were to pass away tomorrow, what ends up happening with that note of 60,000 before they give my wife the 1 point whatever million?
They're going to take it from the death benefit.
Exactly. They're just going to take it out of the death benefit. So they would subtract 60,000 from Diane's death benefit, and she'd end up with about 1 million. But now you understand why it's a non-structured loan, because they don't have to. They've already calculated how many white 58-year-olds are going to die this year. And if my number ain't up, it ain't up. So at 1 year, 5 months, we just talked through that. They take out a loan. They pay off this Visa with a non-structured loan. But this is private equity banking. So they are going, this John is going to pay back that note as though it was a structured note.
No issues. What I was wondering, like, what is the structured and non-structured loan means?
So a structured loan is what we do as loan officers, where somebody has to make a payment every 30 days.
Okay.
A non-structured loan means that the repayment of that loan is not structured. In other words, it isn't built every 30 days or every 60 days or whenever. It's whenever I want to pay it back.
So the loans which we take from our insurance plan is non-structured. That's what you're saying, right?
That's correct. Yep. And so, but in this scenario here, this person's going to want to pay it back, because the sooner they pay it back, the more money they've got available to then pay off their next debt. So what they basically do is take that same payment. If we go back just a couple screens. Okay. So on here, you can see that this Visa that they're paying off, their minimum payment is $517, but their actual payment is $600. So what we're doing is we're continuing to pay the minimum payment on that credit card, but that difference of $83 between the $517 and the $600 is now going into the cash value insurance policy that is allowing them to grow that money infinitely at a compounded interest rate and never have to be taken out again. It can be borrowed against, but it never gets taken out to pay things off. Does that make sense, Shafiq? Okay.
After paying minimum debt payments for 7 months and building up the cash value, the Debt Action Plan will now tell Tom to take out his first loan from his policy. That amount will be equal to the first debt he pays off. In this case, about $5,500. The loaned amount is sent to the credit card, paying it off in full and canceling out the interest he was scheduled to pay to Visa. Now, Tom has a new loan from his policy to pay off, but at a much lower interest rate. The $185 he was paying each month to his Visa bill will now go to the loan he just took out. The best part about this strategy is that the loan doesn't affect Tom's cash value's earning potential at all. His cash value keeps on earning a guaranteed interest rate, while Tom borrows money from the insurance policy to pay off his debts. That principle is where this strategy turbocharges Tom's debt payoff. After a few months, Tom is able to take out another loan from his policy to pay off the next debt. He implemented the same strategy of taking the minimum payment for that debt and adding it to the minimum payment of the first debt and sending that amount to his policy each month to pay down the loan. He continues to pay the $1,200 to increase the cash value each month and sends in the extra $625 to pay down the loan. He keeps implementing this strategy until all the debts are paid off. In this case, it took Tom just under 3 years to get his consumer debt paid down and another 6 years to pay off the mortgage. So, a total of 8 years and 7 months, and Tom is now debt-free.
So that's what we're doing there. So yes, they would continue to make that, if you will, $517 payment or $600 payment each month to now pay back the $16,000 that they just borrowed to pay off this debt. Okay? But here's the cool thing. They still have a cash value there of $18,000, and that's still growing. So they just paid off that Visa. Notice that the Visa is paid off, but they still have a loan now to the insurance company. Does that make sense? And so they'll continue to make that payment of $517 or whatever that was, but they're now paying off the insurance company loan instead of the Visa loan. So what they've done, as Charday pointed out very early in this conversation, is they're trading a loan that was costing them, 19% or something like that, for a loan where they're actually paying 20 basis points or 50 basis points, or they're actually getting paid money to borrow. Does that make sense? That's why we do this, and that's why this becomes so much more powerful than a typical snowball effect of paying off debts. And there's still that $3,572 sitting there. So if John got some crazy idea and decided he wanted to get completely out of this and say, okay, I want all my money back, he can go. He has $19,437,000 in his cash value. He has a policy loan of $15,800. So if he said it's over with today, I'm done, I want all my money back, they'd pay off the loan and they'd still send him a check for $3,500, and he'd still be 100% paid off on that Visa. Does that make sense? So now let's move this out to 1 year, 11 months. And now we're going to pay off the second loan, the Discover card. Okay, same concept. Now they've got $5,698 still in cash value. They have a debt of $19,000 to the insurance company, and they have a cash value that's still growing at whatever percent, 4, 5, 6% of $25,000, because that never disappears. That is never used to pay off. Their cash value is never used. That's always sitting there earning an interest rate. Does that make sense? Okay. So now let's jump out to year 10, just rolling forward, and you'll see that they just took out a loan for $138,000, which now pays off their last debt. They still owe money to the insurance company, but look how much money they've got sitting in their cash value, $170,000, which is a difference of 30 grand still sitting there, right? So if they continue to make that same payment, how long is it going to take them to wipe this part out? Does that make sense? Maybe another year or two? So now they can begin to build wealth. So now if we go out to year 24 and 7 months, when they would have just been paying off all their debts, let's look where they're actually at. They now have assets of $1 million. If they continue to put away what they were paying anyhow 24 years prior to that. Let that sink in for a minute. Is that cool? It gets them out of debt completely in 10 years and builds wealth for the next 14. Let me walk through what we actually show these clients. So either you or your clients, again, you're going to get a summary of how this works. So we identify inefficient monies. We make minimum payments on the existing debts. We build up cash value. Then we borrow against that cash value to pay off our debts. And so the debt action plan gets this family out of debt in 10 years and 4 months instead of 24 years and 7 months. And again, this is all crafted specific to your clients that we're working with, or you. So again, I go through the inefficient funds and where that's being used. And then I go through the debt action plan and how to get rid of those debts right here. And then I show them how that wealth is built at 10 years, at 20 years, at 30 years, at 40 years, etc., and how that continues to grow. So let's look at this. And again, I want to ask some questions of the loan officers here, and we're all loan officers. So the first debt gets paid off of $15,000. That was at Visa. And it shows the date when that should be done. So then, 6 months later, the next one, 4 months later, the next one, the car loan, a year and a half later. At this point, loan officers, when the only debt left for this family isn't a car, it isn't the revolving debt, all that's left is their home, and you know about that date, what could you do? Well, what could you do every single time one of those dates comes up with your client? Charday, yeah, there we go. Ellie put her ear to their phone. Make a phone call, right? Yeah, you can call them up. Hey, John Smith, how's it feel to have paid off that Visa? Oh, I slipped. I went and put a little bit more money on it, but next month I'll pay it off. Okay, cool. You call back next month. Hey, John, how'd it feel to pay off that Visa? Cool. You call back 5 months later. Hey, John, how'd it feel to pay off that Discover? Cool. Hey, what's your credit score gone to? Have you been checking it on Credit Karma? I know that one sucks, but you get the idea. You call back after 10 months. And you're like, hey, you finally wiped out that payment for your Amex. Oh, hey, a year and a half later, you finally paid off your car. Where do you think their credit score is now if they were at a 680? And they've paid all this stuff up. Exactly. Hey, John, you know what? Now that we got your credit score above 720 and interest rates have gone back down, how about we refinance that bad boy without taking a penny out, and we put it on a 25-year note? You got a smaller payment, and you get the idea, right? We're all loan officers. You can help your clients. And then they keep paying that same amount toward paying off their debt. And at the end of, again, I'm guessing that somewhere after paying off their car and before they pay this off, what are they going to usually do? Move? Buy a bigger house? Buy a smaller house? Get a condo? Get them a fourplex? Again, that's why we as loan officers, by knowing these dates and understanding when these people are coming in and out of debt, we can help them and become more transactional at the same point with our clients. Okay. So this is another example. This was an engineer that I worked with. Had about, how much in total debt? Current balance was $609,000. Interest payments over the next 29 years was going to be $526,000. Almost the same amount as their total debt. Total payments, $1.2 million. And so we were able to get them out of debt. Instead of 29.7 years and paying $526,000 in interest, we were able to help get them out of debt in 9.3 years. This is one that I did for a business client. They had enough money in the bank to pay off the mortgage on the property where they had their small retail outlet, and they were worried that the economy might go bad. So we did a policy where they were able to put in $200,000 in 2 years, borrow that out, and pay off the mortgage. And it was just very fortuitous because we did that and got that mortgage all paid off in October of 2019, and then COVID hit and their little business struggled for about the next year. But because the mortgage was paid off, it wasn't as difficult for them. So again, access to capital quickly, no credit checks, no begging for borrowing P&L, smooth out the cash flow for some seasonal businesses, unstructured loan repayments, etc. Anyhow, that's what I wanted to show you folks today, was how to get out of debt and then build wealth with this. This is something that I can do for, again, any of you as well as any of your clients.
I actually found you on YouTube. I watched a few of your videos.
Oh, did you? Yep, I'm out there. So I've got this is my, you guys still seeing the screen? So this is my website, privateequitybanking.com. You can also find me there. And then on all of these presentations, I've got my phone number and my email address. If you go in here to the library, I've got a bunch of webinars that I've done over the years. So Private Equity Banking 101. Then I've got Debunking Dave Ramsey's Claims about Private Equity Banking. That's a fun one. This is the one that I showed to Mike Cordes 3 extra real estate investing using private equity banking, real numbers, etc. Now, most of you will be as bored as I'm sure Mike was during the first 17 minutes of it because you know everything up till that point. But after you get to about minute 17, I go into more in-depth numbers and such on how to make money as a real estate investor using this. This is a fun one. Where do banks put their money? By the way, if you've ever wondered how those bankers get these huge paychecks, it's because they're using private equity banking accounts to pay their salaries. So, some cool stuff. 3 key financials of the affluent. And then on the home page, I've got another one that I think is fun too. It's way at the bottom. It's called average versus actual rates of return, where I walk through the differences between what your financial advisors say is an average return versus what the actual return in the stock market is, and I compare that over a 20 and a 30-year period. And again, you can get guarantees that it'll beat the stock market, even the S&P, by using this kind of a concept. Did that answer that question for you, Shafiq, about how to get in contact with me? Let me see.
Yes.
254.